Hey guys, it's Wayne again. I'm here to talk to you about life insurance and just some of the basic concepts, okay? Now, just for a definition of what life insurance is, a life insurance is a contract between an insurer and a policyholder in which the insurer guarantees payment of a death benefit to a named beneficiary when the insurer dies, right? The insurance company promises a death benefit in exchange for premiums paid by the policyholder. So, couple of things there. Number one, who is the insurer? Well, simply, the insurer is the insurance company. You name them. National Life Group, Pacific Life, Progressive. You name it. All these are huge carriers, and some of them offer, most of them offer life insurance products. So, and who's the policyholder then? Well, the policyholder is the person who actually took the policy out, right? The person who's ultimately responsible for making those premium payments, right? And the insured is the person whose life is being insured. The person who, when they pass away, all right, their beneficiaries will receive that death benefit. Okay, so now when I was in college, like eons ago, well, it feels that way. It's not really that long, but it's some time. Um, I studied business law, and one of the key concepts I take took away from that, right, is the whole concept of what's a contract, and a contract must include an offer, an acceptance, and consideration. So in the context of life insurance, the offer is the insurance company underwriting that application that you submitted, and then saying, "Hey, Wayne, here's what we're going to offer you based on your application, the information you put in the application, some other factors. We're going to offer you this amount of face amount," or actually, they're actually looking at the insured. So if the insured is different than the policyholder, they're going to be looking at the insured's health and lifestyle. Okay. Now, does that person, have risky activities? Like, do they like jumping out of planes? Do they like to go skydiving? Or it's the same thing, right? Jumping out of planes is skydiving. And do they like bungee jumping? I mean, anything like that's going to be a high risk factor. The insurance company will not take that so kindly. All right. The policy may get underwritten, but it's going to probably be at a very high premium, right? Because for them, from their perspective, you're high risk, right? You're risky insured. There's a high chance that you will pass away earlier. And the last thing the insurance company wants to do is pay out a lot of money, when they haven't even received any premiums, right? So, so it has to be a life insurance has to be legally binding. It's a legally binding contract, right? And that means it meets the condition of what a basic contract is, the basic elements, right? As I mentioned before. And one of the other elements I didn't talk about is the consideration. Well, the consideration is really the premiums, right? The premium payments. When you make those premium payments, you've given consideration. Without that piece of it, they can't be an enforceable contract, right? Now, what also makes the contract enforceable is the application. What did you put on the application, right? Did you, as I mentioned before, did you mention your high risk activities? Did you mention your current health condition? As a matter of fact, I want to tell you a quick story. So, someone I know, or someone I knew rather, he passed away, God rest his soul. He took out a life insurance policy. Was a huge smoker, right? Huge smoker, right? And when he took out the policy, they asked him the simple question: "Are you a smoker?" Because if you know about insurance, they like to rate, meaning they like to, have higher premium rates for people who smoke because they see that as a high risk activity. So health wise, so and the facts are there. It's proven that people who smoke have a higher chance of many ailments, right? So the insurance company, apparently what happened is, once he passed away, they looked through his portrait. There was an autopsy done or whatever, but ultimately they realized that he was a smoker, right? It came out that he was a smoker, and basically the contract became unenforceable, right? The insurance company had didn't have to pay anything because he lied on the application. So One of the things I tell my clients is when you're going to take out insurance, make sure that you're truthful and accurate to the best of your knowledge, because the insurance company A will take a look at what's called an MIB, right? A medical a database that shows, what medications you've been taking, right? And possibly some of the details behind your hospital stays and whatnot. So they can find out this information. And let's say they don't find it out. Like the gentleman I mentioned before, he was a smoker. He didn't disclose that, and ultimately had a problem, right? So the contract became unenforceable because he wasn't accurate, he wasn't truthful on the application, right? So the last thing you want to do is not be truthful on the application, right? So um, life insurance policy to remain in force, you have to pay the premiums. You can pay the premiums in different ways. Single premium, you could pay the entire thing in a lump sum, right? You could It's called paid up insurance, or you could pay quarterly, you could pay annually, or you could pay monthly, right? So basically, they divide the premiums in whatever way you want, whatever is most comfortable for you. They make it easy, right? And most insurance companies will offer an option for you to do electronic funds transfer. You can make a payment to them that way, or you could send them a check. But most time these days, it's done by electronic means, right? So let's talk a little bit about the so the insured dies, right? What happens then? The insured dies, and assuming he didn't lie in his application or anything like that, everything checks out fine. The insurance company cuts a check to that beneficiary. You know the sweetest thing about that is, honestly, the sweetest thing about that payment is that that payment is 100% tax free, right? Of course, when the person was paying the premium, most likely they used money that was taxed already to pay the premiums. So now the benefit, whether it be $100,000, 500,000, a million, $10 million, totally tax free. Isn't that a beautiful thing? I love tax free. I mentioned that before in one of my videos that I love tax free. I love tax free money. So the fact that you get that benefit tax free, that can be a huge start for say a young person, right? God forbid a beneficiary that's young, and he gets $500,000 to now start his life. He can invest that money. He can take out another insurance policy on himself for his dependents. So there are different things that you can do with that money, right? So let's talk a little bit about what the types of insurance that you have. The basic types you have: term and permanent. And term is basically for a specified, as you can tell probably by the name, a specified period of time. It could be a 10-year term, a 20-year term, a 15-year term, or 30-year term. Those are the most of the common denominations. But when you have that policy for that period, for that term, it's gonna eventually lapse. It's gonna come to maturity. And what happens if it comes to maturity? There's nothing that's paid out on that policy. Okay. So that's your term. Your permanent is more policies that really don't expire. The only way those policies lapse is if, well, the only way those policies come to term generally is if you stop paying the premium, right? In which case it's going to lapse, or if you surrender the policy, right, for its cash value, because most of those policies they build up cash over time, right? It's called cash surrender value. I'm going to talk about that in another video, right? But typically that policy is a permanent policy, which means it doesn't expire. There's no term on it, okay? As you would find with the term policy, all right? So the other thing you want to know is that the the there's a direct relationship between the likelihood that you're going to get paid by the insurance company and the rating of that company, right? There's a direct relationship. So the higher the rating is, the higher the chance that you're going to get paid. So um, most insurance companies, well, the insurance industry is highly regulated state by state. And so the insurance companies have to meet those regulatory precepts and to ensure that they're adequately capitalized so they can make payment. If something happens and they can't pay, there's state funds that will hopefully pay out to beneficiaries in that event. Doesn't happen very often. Insurance companies are notoriously, or I shouldn't say notoriously because it sounds like a bad word, they are very um, um, well managed, most of them, especially the highly rated ones. The ones that are rated A plus or A, or B plus. I'd say I wouldn't go with an insurance company. The most of the companies that I deal with, they're A-rated companies. Okay, so that's important. It's important to know that you need to put your money with a company that has uh, pretty good financial strength, and that you know will have the ability and the willingness to pay out if there's a claim. Okay, that's very important. So, um, who would need insurance? I'm probably going to save this for another time, but basically, parents with minor children, parents with special needs, and adult children, adult, adults with other property together, elderly parents who want to leave money to adult children, and it runs the gamut. There are probably like 10 or 15 reasons why one would need insurance. I'm going to talk a little bit about that in another video, okay? I'm not going to bog you down with that today, but really, insurance is a great thing. I would recommend it highly. My dad took out a policy for me when I was very young, and so I see the value in it, right? And the policy has grown. It has increased in cash value, so definitely it's something that you should think about. But listen, I'm gonna run now, but we're gonna come back another time. We're gonna talk a little bit about the various people that may need insurance and why they would need it, why they're good candidates, and we'll talk a little about that at length. Okay.